Okay. So we'll start off with a warm up, which was Gordon's, and then now we're going to get into the context of GameStop, the company, what happened with Reddit and leading up to it, then the shorting and the the short selling and the short squeeze itself, and then finally the aftermath with Robinhood and Twitter, and then other stocks that you might want to look into, as well as the discussion. So I don't want you guys to answer this right now, but consider, do you think what happened this past week was market manipulation? And I guess try to find a reasoning for why you think so. Okay. So context. Colleen, why don't you take it away?
Yeah. So before we jump into any content, we're gonna need some context. So I'm just gonna review hedge funds and the difference between short selling and short squeezes and how that all ties into the GameStop stuff. Okay, so if you don't remember, a hedge fund is a fund that investment companies invest their clients' money into in order to try and beat the market. So it's a more aggressive investment option, but it tries to reduce risk and tries to create higher return in both up and down markets. Some characteristics of hedge funds are there are higher fees, they're illiquid because they often require investors to keep their money in the fund for at least a year, and this period is called the lockup period. They also include a wider range of investments, including land, real estate, currencies. And this is compared to mutual funds where you basically just stick to stock and bonds. If you don't already know, r/Wall Street Bets is a subreddit where members discuss stock and option trading. So an explanation of short selling and short squeeze in GameStop context. The investment companies in this case were short selling with their hedge funds, which means that they were trying to profit off the decline of GameStop's market price. And then the subreddit members bought a lot of GameStop's stocks, forcing the price to increase out of demand. And then this created a short squeeze because the traders that bet the price would fall were forced to buy the stocks to prevent greater losses.
All right, so many of you may be confused about what Colleen is saying. She pretty much summed up the situation beautifully, but if you guys are still confused, we'll get that into a second with short selling and short squeezes. We actually reviewed short selling earlier this year. I'm not sure if you guys remember, but it's really important to just have a little refresher on what short selling is because it's super relevant to the situation. So just a basic definition for starters, short selling is an investment or trading strategy that speculates on a decline in a stock or other securities price. In other words, it is sort of like a bet against a security. Now, usually when you buy a certain stock, you would buy low, sell high. In this case, it's sort of like the reverse where you sell high, buy low. There is a high risk reward ratio. You have the chance of getting large profits, but there is the risk of having an infinite amount of losses. If you guys remember, I told you guys to visualize sort of a graph with the stock price on the y-axis, the time on the x-axis, the range or y for that graph would be going from 0 to infinity. And the way that short sellers make profit is if the price goes down in price. So if it goes up an infinite amount, you have an infinite amount of losses. And there's also, there are prerequisites in doing short selling. Like you need certain qualifications to actually engage in the strategy of short selling. It's not as easy as buying a stock on Robinhood. In fact, you can't even short sell on Robinhood. And you do need a margin account. And when you short sell, you are borrowing shares, and there is a price to pay when you borrow shares. So there's also incurred interest. So what does this look like? Next, if you can go to the next slide, let's just visualize that if the short seller were to or the hedge funds in this case, were successfully shorted GameStop. Let's just say that Wall Street Bets was never a thing and the hedge fund successfully shorted GameStop. So of course, the numbers here aren't reflected in the real life scenario, but let's just say that GameStop was priced at $50 a share. If the short seller speculated that GameStop's price was a little bit overvalued, perhaps because of the competition with virtual or digital games and the COVID-19 situation, less people are going to the GameStop stores. Let's say they speculate that the price of the shares of GameStop will go down. So what will they do? Well, if we go to the next slide, the short seller would actually borrow 100 shares of GMA stock. And if we go to the next slide, short seller would sell the GME stock for $5,000. Now, where does the $5,000 come from? Well, it's just simple math. It's if you sell 100 shares of GME at $50 a share, that'd be $5,000. So that $5,000 is cash at hand for the short seller, but that $5,000 is also $5,000 in debt because remember, the short seller borrowed 100 shares of GME stock. So if we go to the next slide, let's just say that the short seller was correct in his speculation and the GME stock went from $50 a share to $40 a share. And the short seller decides that, hey, I want to pretty much close on my position. Oh, by the way, when a short seller borrows shares and sells it immediately to the market, that is called a term called that term is called buy to open, sell to open. Excuse me. When you borrow shares and sell it immediately to the market, that is called sell to open. Now, if the short seller wants to buy to close, which is a term where you unwind your short sell position, he he or she would buy back those 100 shares. So if we go to the next slide, the short seller would buy 100 shares of GME for 4,000, which is $40 times 100. And if we go to the next slide, the short seller return those 100 shares of GME stock to the broker and keep the remaining difference of $1,000. So hopefully you guys can see this process of short selling. I try to keep it simplified as much as possible, but essentially what the short seller does is they borrow shares, sell it at the price, wait for the price to come down, rebuy those shares, return those shares, and keep the price difference. So hopefully you guys can see that. And pretty much this is what the hedge funds were trying to do with short selling because they thought that GameStop was overvalued in a sense. But unfortunately, this was just a fantasy of the hedge funds as Wall Street bets came into the market. And this is pretty much going to be explained by Cassie with short squeeze in the next slide.
Yeah. Okay. So Matt just explained what would have hypothetically happened if r/Wall Street bets didn't exist, right? But what we'll talk about first is the theory of a short squeeze, and then we'll apply it to GameStop. So a short squeeze is basically when a stock price jumps sharply higher, and what happens is short sellers have to buy it back. They basically buy back the stock so that they can return it. And then when they buy more stock, right, this is like demand for the stock, then the stock price actually increases even more, squeezing out the people who still are holding on to their like shorts. So this is basically this kind of fast-paced process that has occurred a couple times in history. So like Matt said, shorting has infinite potential for loss, right? Because you don't know how high the price will jump. And the higher it jumps, the more you are losing because you are basically selling for something and then you're actually buying it back for more. So this is, instead of a profit, this is your loss. And you can have infinite loss, which is very dangerous. And it's important to remember that short selling is sometimes correct, right? Sometimes the short sellers think that a stock is overvalued and they think that eventually the stock will correct itself, the price will go down and then they'll profit. And in the case of short squeezes, a lot of times it's not really based on analysis and that's not a good or bad thing. It just usually mostly based on the fact that, oh, I see a bunch of people like short selling and I think that they're wrong. Or it could be mob mentality with a lot of people bandwagoning after a couple people do it. And usually short sellers will usually bail out right after they start like losing in the market, right? Because they know they have infinite potential for loss and they don't want to go through with all that loss. What they'll do is they'll cut the losses short, maybe like lose like a couple thousand or 100,000 or whatever, instead of what they did this time, which is really unique with GameStop, which is that they held on for a really long time until they literally got squeezed out. Okay, so when you are a short seller, let's say you are the hedge fund and you short a stock, so you think that the price will go down, but then the price actually jumps up. You have two choices, right? One, you continue, you basically add more collateral or interest and you give that interest to your broker, and you convince them, yeah, I'm gonna like continue shorting, I think I'm correct. Or you can bail out. What you bail out with is basically you just buy back the stock that you just sold, even though you are losing some money, and then you give that stock back because you don't own it, right, as a short seller. And this basically means you're cutting your losses early because you think that it's going to drop even, or it's going to rise even more and you're going to lose even more money. So if you look at the graph on the left, you can see that around January 22nd, it started like really hiking up to over 300. I think it reached over 400 at one point, but it only closed at like 300 max. And you can see that it did fluctuate for a period of time, right? This like pretty significant drop and then a pretty significant increase again, and then a final like free fall. And so this is like basically when the short squeeze really started happening. And then with this chart over here, you can see that short squeezes are not exactly rare. They do happen. And the most famous one before GameStop was Volkswagen in 2008. I honestly don't know very much about this one, just that it was basically the flagship short squeeze before GameStop. And if you can see here, the average, usually a short squeeze will last 12.4 days. So GameStop was a little bit on the brief side with 10 days. Okay. And with this chart, you can see here that this is when it started really hiking up the price, right? And when a short squeeze exhausts itself, usually the price will decline by around 50% in the next 3 to 4 days. And with GameStop, it actually decreased more than 50%. You can see like down here, it decreased like 31 and then 60%. And I checked as of this morning, it decreased 81%. So that is pretty significant. And then one other unique thing about this specific GameStop incident was that you saw with the previous chart right here that there was a decline on this this period over here, right? And this decline went back up. So it did fluctuate. It didn't go straight down, which is pretty unique because usually with short squeezes, it'll just be like pretty straight instead of like the segmented, fragmented incident that we saw. Okay, so before moving on, a little bit of background information. So if you guys already know about, maybe you guys are on Wall Street bets, but basically it was a large group of people, started out pretty small actually, and it's been going on for a while, but the movement gained a lot of steam, and it was basically this one guy, I think Keith Gill, named Roaring Kitties or something with an expletive. He has multiple usernames, but usually, so what he did was he basically thought the short sellers were wrong. He's been talking about GameStop for a while now. And I think a lot of people joined the movement for different reasons, right? Some of them joined out of loyalty or attachment to GameStop because a lot of them are gamers. Some of them joined because they genuinely think GameStop is undervalued because they are still selling game consoles, right? Even though they're not exactly succeeding in the like video game itself industry, but they are still selling consoles. Next, a lot of them did like the narrative of the David versus Goliath. Like if you've seen anything in the news, they probably mentioned that, right? Like the Bible story. So it's the like the little man versus like the big man. And so a lot of them like that narrative, so they bought into that. And that's fine. That's like their reason. But those are the main reasons that people wanted to buy into GameStop. And final thing before we move on, what's important to remember with the short squeeze is that the hedge funds were not the only ones that were short selling. They were just the main ones that are short selling. And when one of them decides to bail out, like any hedge fund, right, like Citron or something like that, what happens is this adds on more demand because they've decided to buy the stock so that they can give it back. And whenever there's more people buying the stock, like more hedge funds buying back that stock, you're increasing demand, which, as Colleen says, means you're increasing like upward pressure on the price. So more buying, for whatever reason you're buying, that means that the price is going to like skyrocket. And that's why this price kept going up and up and up, because the hedge funds were forced to buy. And so when they were forced to buy, they squeezed out other hedge funds, which is like the irony.
Right. So now we're going to be talking about options. So just as a review, because I think we've been over this a couple of times, but an options contract is basically an agreement between a buyer and a seller, which gives the buyer the right to buy or sell a particular asset at a later date. So the right to buy an underlying asset is called the call option, and the right to sell being the put option. So as part of the Wall Street Bets' plan, many retail investors bought up call options on GameStop. As a result, market makers, aka the people who sold those call options, which basically represent a pessimistic bet if you sell a call option, they had to buy the underlying asset, in this case, more GameStop shares, to hedge or basically neutralize their market exposure, thus inducing a self-feedback loop similar to the short squeeze mentioned or described by Cassie, where basically they were creating more demand on the stock because they had to buy back shares to kind of neutralize their exposure in this particular investment. And as a result of this increased demand in these new option contracts, option premiums spiked significantly, and with premiums being the price of the contract, as implied volatility, a metric that's basically calculated by looking at the premium price, was above 1,000, or peaked above 1,000%. And as a matter of fact, at the money options, which basically are options where the strike price equals the stock price, with the strike price being like the the price that is a previously agreed upon price that people will purchase the underlying asset or GameStop stock in this case, cost half. So that premium on that option costs half the share price, which implies 500% volatility. And because it's an at the money call option, it has no intrinsic value, meaning the price is consisted entirely of time value, which means that it's based on the underlying asset, GameStop stock, their expected volatility, and the time until option expires. So basically, because the stock is so volatile, the premium or the price of the options contract reflect that. And if we look to the graph to the left, we can see that options contracts peaked during this time, or to above over 1 million contracts traded during or call volume, which basically like the volume total amount of contracts traded during this time, with the small portion being put options, which are basically the right to sell. But basically that, if you can see from the upward trend in the graph, people are feeling really optimistic about the stock and really pumped up prices of the premiums of the stock, as well as the stock itself, which is really interesting.
Yeah, well said. And basically, options are unique because they're a way to basically decrease risk, right? Because you're not actually buying or selling. You are buying or selling a contract that says that you have the right to buy or sell. And it's kind of complicated, but Ronak broke it down pretty well. If you want more on it, there are a couple links we set in the Discord, as well as one that Colleen sent in the chat that was actually written by Ronak.
So jumping into a quick look at the statistics, the shares rose over 1,600% in 3 weeks. It closed at 325 last Friday, and as of I think over the weekend they dropped down to like 120, somewhere around that, and that's just because, of course, after hours trading, which we can get into later. But essentially, yesterday it was down 60% to $90, and market cap fell 17 billion to 6.3 billion just over the weekend, reaching a 52-week high at 483 last Thursday, and it opened on Thursday at that price because of after hours trading. And there, in terms of shares outstanding, which is how many shares there are of GameStop, 69.75 million. So compared to something like Apple or Google, a big company where you have like 20 billion, 25 billion shares, why is it so important, or what's so bad that there's only 69.75 billion shares? Like, why is it worse if there's a really low shares outstanding? Can anybody tell me? Just unmute or just throw it in the chat. So the reason why it's not good to have less. Yeah, that is one reason, Russell. It is easier to drive the price up. But another reason is that it prevents, like, there's just not enough shares to get your hands on. People are scrambling to get options for GME just because there aren't enough to go around. So essentially, when people have when they have a position on a stock, but there's not enough shares to go around, they can't close the position. And I don't know if we're gonna get into Robinhood today, but Robinhood recently stopped allowing trading of GME, and that's an issue that we might get into later. Another statistic, beta is at negative 1.97. Can anybody tell me what that means, or just what beta is in general? Anybody could just unmute or just throw in the chat. Okay, so beta it insinuates the correlation to the market. So when we have a negative beta, yeah, exactly. Oh yeah. So we covered this in our in both our bootcamp, and it's apparently covered in the financial markets course on Coursera. But when we have a negative beta value, that just means that the volatility of the stock is the opposite, or it's going in the opposite direction of the volatility of the market. When we have such a high beta value that's negative, that just means that we're inversely correlated to the market. Market goes up, this stock goes down. Market goes down, this stock goes up. And then here's just a graph of the progression of day trading yesterday. Pretty much already went over all the statistics though.
Right. So as many of you know, and as Gordon just mentioned, in light of the recent volatility, Robinhood, the brokerage which many of the Wall Street Bets investors use, restricted trades on a number of stocks, namely GameStop, AMC, BlackBerry, and Bed Bath Beyond. And the list actually grew over the last couple of last week. So basically, users were not allowed to buy more shares in the company and could only close out the position, meaning they could only sell their shares. And other brokers like TD Ameritrade and Charles Schwab, which are also pretty popular with smaller investors, placed similar restrictions. So as you can imagine, there was a lot of controversy surrounding that decision. The next day, so this happened on Thursday, so last Friday, basically, Robinhood clears up the air and basically says it's because Central Wall Street Clearinghouse mandated deposit requirements increased tenfold. And while that sounds like a mouthful, and it is, I'll pretty much break it down. So basically, clearinghouses are SEC organizations that act as like the central depository for securities. They basically keep a record of the stocks owned through a brokerage. Brokers like Robinhood Securities are members of this clearinghouse. These clearinghouses have membership rules approved by the SEC that govern the activity of these members. And one of these things are they establish financial requirements for members, including deposit requirements designed to reduce risk to the clearinghouse itself. And one of the ways they calculate this kind of deposit requirement is by looking at volatility of customers' portfolios. And because this stock is highly volatile, as indicated by its beta of nearly -2, the deposit requirements, basically the money that they keep with the clearinghouse, increased tenfold, which is significant, because then it becomes a lot harder for Robinhood to meet that deposit requirement. And if they don't meet that deposit requirement, well, they're in hot water and kind of screwed. So this raises questions of market manipulation, which I'll just define here now, because we'll go more into that in a few slides. But market manipulation is basically the art of artificially inflating or deflating the price of security, or otherwise influencing the behavior of the market for personal gain. And now threats of market manipulation have been hurled at pretty much every party involved at this point, including the hedge funds, Robinhood itself, Wall Street Bets, investors, etc. Looking at the next slide here, we can see kind of the effects of Robinhood restricting trading. We see that the price climbed to far above $400. And then immediately following Robinhood's restriction, the price plummeted all the way down to the hundreds. And obviously it picked right back up, or not right back up, but it did pick up once Robinhood lifted the restrictions. But now we're still seeing the effects of some of the restrictions.
Okay. And lastly, we have the media's take. So there was obviously a lot of backlash and sympathy on both sides of Wall Street Bets and the hedge funds, also with Robinhood, also with the SEC and the Fed. So there's definitely a lot of people at play here, and there's a lot of criticism thrown on all sides. Okay, so instead of a quote, I thought it'd be more apt to have Twitter instead. So on the screen, you'll see some tweets from supporters like Elon Musk, and also critics of Robinhood, and also people calling for Janet Yellen to like do something. Janet Yellen is the head of the Treasury. So I'll just pause here and give you guys a couple seconds to read these. Okay, so yeah, it's a lot, and it's interesting that we have a lot of politicians who normally would not ever agree on anything, somehow agree on Robinhood not making the right decision by restricting this, but that's up to you guys to decide for your own whether you think that was the right decision.
All right, so while it's important to pay attention towards GME, GameStop. The squeezers of Wall Street bets are also looking for stocks with high short interest ratios, which means those stocks of AMC and Bed Bath & Beyond are being sold short too, along with the many other shorted stocks, similar to GameStop, except for Dogecoin, of course. Dogecoin is not a stock. It's actually a cryptocurrency similar to Bitcoin, but except it's inspired by a meme. You can't short sell or squeeze Dogecoin. The only reason why it's rising now is because of speculation and people spamming emojis on the Wall Street Bets Discord. Now, AMC theaters and BBBY have been seeing jumps recently, but it's hard to know what's happening without being glued to both the markets and social media. There's a lot of noise here. And the new efforts by the squeezers are actually much less coordinated than GME's because GameStop's rise, it actually took months to pull off. So shouldn't you be buying into these other stocks? In my opinion, probably not.
Okay, and before we get to discussion, we do have a couple links for you guys. We will be sending these out in an email. I'll go over them real quick. So the first one is Roaring Kitty, the guy who started it all. If you want to know about him, I guess check out that New York Times article. The second one is something Colleen found, which is, I think, an explanation of the entire situation under the, I guess, like story of Animal Crossing. But yeah, I mean, if that helps you, that's great. The third one is about Elon Musk. The fourth one, fifth and sixth are all from Street Fins. And they're just kind of like basics about Robinhood, after hours trading, and options. The third one's written by Ronak. And then the one after that is a Robinhood blog post describing trading mechanics. Robinhood, again, does not charge you extra for transactions. That's why they've been historically popular with individual investors. I don't know about anymore. After that, there's option trading on GameStop. And then the last one is if you're interested in the emojis and you don't already know, there's like a ton of sites basically trying to explain the emojis used on r/Wall Street Bets. Okay, so discussion time. I will read these aloud, and I would much prefer you guys to unmute and say anything. We won't judge. This should be a judgment-free zone. I want you guys to basically feel like you can say whatever you want within reason, because I don't want to tell you what to think, even though I have my own opinions. Okay, so the first one is, do you think what happened was market manipulation? And like Ronak said, there's been a lot of critics on both sides. So people have been calling everyone market manipulation, accused everyone of that. So you can talk about whether you think a specific group was or not. The second one is a lot of people criticize Robinhood, but what would you do if you were Robinhood? The third one is, what do you think Janet Yellen, head of the Treasury, and the SEC, the Security Exchange Commission, should do now? They are meeting, I think. They are meeting either like today or tomorrow or something to discuss whether they should do something about the current market and, like fix volatility. The last one is diamond hands or poop emoji hands. What do you think you would have done? Would you like bought or sold at what specific point? Of course, in hindsight, I guess you probably have some bias, but what do you think? So yeah, I'm opening up the floor. Anyone can unmute. You could, yeah, you're right, Gordon. I will stop the recording temporarily. Actually, no, we're pretty much done with the material part. Let me stop the recording.